Short selling is the act of betting against a stock by selling borrowed shares and then repurchasing them at a lower cost and returning them to the broker at a later time. It's relatively a sophisticated and risky trading strategy that requires a margin account and a keen understanding of the stock market. It may not be appropriate for stock market beginners. Hey, it's Frank Nagy and welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, click on that subscribe button and hit that like button. Many hedge funds utilize shorts or shorting a stock to hedge against any losses to their long stock positions. With careful risk management, you too can realize and utilize this sophisticated but risky strategy to speculate or hedge trading opportunities. Now here's an example of shorting a stock. Let's say you borrow 100 shares of stock that you believe that will decrease in value and then immediately sell them on the stock market for $10 each, generating a $1,000 credit. If the stock price drops to $8 per share, you could use your $1,000 to buy back all 100 shares for only $800. Then return the shares back to the broker, and in the end, you made $200 of profit in your short position. Now here's how to short a stock in 5 steps. Number 1, margin account. Borrowing shares from the brokerage is effectively a loan and you'll pay the interest on that outstanding debt. The process of obtaining a margin account varies by brokerage firms, but you'll probably need to be approved for it. Make the trade. When you place your trade, you'll need cash in that margin account as collateral, equivalent to at least 50% of that short position's value. If this is satisfied, you'll be able to enter short sell orders in your brokerage account. It's important to note here that you won't be able to liquidate that cash you receive from the short sale until you close that position. Hiring experienced hedge fund consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your long-short hedge fund. As part of our services, I will make the appropriate deductions to prime brokers, administrators, and auditors that will best suit your hedge fund's needs. Maintain enough collateral to cover your loan. You must keep enough equity in the account to serve as collateral for the margin loan at least 25%. And this takes in the form of either cash or stocks or bonds or that you already own in your brokerage account. Paying interest on margin. You can maintain the short position for as long as you need, whether it's only a few hours or a few weeks. But remember, you're paying interest on those borrowed shares for as long as you hold them. And you'll need to maintain that margin requirement throughout the period also. Close your position when the stock price falls. When your stock price starts to drop, you'll decide to close your short position by buying the amount of borrowed shares at the lower price and then return them back to the brokerage firm. Keep in mind that to earn that profit, you'll need to consider the amount you'll pay in interest, commissions, and fees that will be debited from your profit. If you're thinking about starting a hedge fund, I recommend my book, The Ultimate Hedge Fund Guide. Click on the link below in the description box to find out how to get it. Do you remember the old saying, what goes up must go down? Well, the same is true on the opposite side. The biggest risk of short selling is the potential for unlimited losses. In a traditional stock purchase, most of the losses that you have are limited to the amount that you pay for the shares and until it goes to zero. But the upside potential of profit is unlimited. When you short a stock, it's just the opposite. Your maximum profit of a short position occurs if the stock price falls to zero. But your losses are theoretically limitless because the stock price can rise indefinitely. Now these are 5 tips on just the basics of shorting stocks. You'll need to do some extensive research on a particular stock to see if that company has the potential to decrease in value in a short period of time. It is a good rule of thumb to only trade with money that you can afford to lose. And that's the wise old saying.